Hi, it's Ezylia here from Taxworld. Today, I'd like to talk to you about Section 29A of the Taxes Consolidation Act 1997. This section applies to individuals who temporarily leave Ireland to avoid tax on the sale of significant shares, referred to as relevant assets. These are shares whose market value equals or exceeds 5% of the company's issued share capital or exceeds €500,000. This rule deems the individual to have sold and then immediately bought back the shares on the last day of the tax year in which he left Ireland. This is to make sure that he will be regarded as Irish resident and subject to CGT on any gains made from selling these shares while abroad. The rule applies if 1. You have relevant assets. 2. You're an Irish resident in a tax year when you return, but weren't a resident for 1 or more years before returning. 3. You were an Irish resident and domiciled in a tax year before you left. 4. You don't spend more than 5 tax years abroad. Let's look at an example. If you lived in Ireland and then moved to Portugal for 2 years, where you sold shares for €100 million without paying tax in Portugal, and then returned to Ireland, you would still need to pay Irish TGT. If you perform a transaction like the one in the example, the gain you made is calculated and charged to you on the last day of the tax year in which you left Ireland. If the actual proceeds or market value at the date of disposal of the assets is greater or less than the market value on the last day of the year of departure, that value will be used for tax calculation. In case you have to pay CGT in both Ireland and another country for gains made while being temporarily non-resident, and there's a tax treaty between Ireland and that foreign country covering CGT, you can get a tax credit up to the amount of Irish tax the foreign tax you paid. You must declare gains made while being temporarily non-resident in your tax return. I hope you found that useful, and I'll see you in the next video.